Hello everyone, I'm Arushi Dua, pursuing Bachelor's in Business Management from MERI Group of Institutes, hereby explaining the topic Valuation of Inventory. These are the following topics I'm going to cover. Now let's start with the introduction. Inventory valuation is the monetary amount associated with the goods in the inventory at the end of an accounting period. The valuation is based on the cost incurred to acquire the inventory and get ready it for sale. Now, what is the meaning of inventories? Inventories are generally held for sale in the ordinary course of business or in the process of production for such sale or in the form of materials or supplies to be consumed in the production process or in rendering of services. The inventories are further classified into three types: finished goods, which is purchased or produced completely but remaining unsold; work in progress, which is also known as work in process, units introduced into production process but are not yet to be completed; raw materials, components, stores and spares. Raw material goods are that are yet to be introduced into the production process. Stores and spare factory supplies such as coolants, cleaning material and machinery spares. Now the objectives of inventory valuation are income determination, presentation of final position, liquidity position, location of wastage. Now the inventory can be recorded in two ways, which are periodic inventory system and perpetual inventory system. I am going to explain both the topics in a very brief manner. So let's start with periodic inventory system, which is quantity and value of inventory at the end of accounting period after taking a physical count of the inventory. It is also known as annual stock taking. Here, cost of goods sold is calculated by opening stock plus purchases minus closing stock. Now it has certain advantages and disadvantages too. The advantages are it is applicable for all business organizations, large or small, dealing with specific or a variety of goods. But under this system, chance of fraud and forgery lies because here continuous control over merchandise is absent. Now the next system of inventory is perpetual inventory system. Under the perpetual inventory system, tracking inventory after every or almost every major purchase. In perpetual inventory system, the cost of goods sold is updated in accounting records to ensure that number of goods in a store or in a storage is accurately reflected by the books. So here are under the perpetual inventory system, an entity continuously updates its inventory records to account for additions and subtractions from inventory for such as received inventory items, goods from stock, items moved from one location to another, items scrapped, items picked from inventory used in the production process. It too has some advantages and disadvantages. As merchandise stock is restricted to a certain limit, the additional investment of capital is not required, which is a big advantage for it. But on the other hand, keeping accounts of stock under the perpetual system in the organization, dealing with varieties of goods is expensive and time consuming, which is a major drawback of it. Now this is the format for perpetual inventory system: the date column, the receipts column, the issue column, the balance column. And under the receipts, issue and balance, there are certain sub-columns which state a number, GR number, quantity, rate, amount, and all of them have same sub-columns. Now there are three different methods of valuation of inventory, namely FIFO, LIFO and weighted average method. I will briefly explain these three. Now FIFO is first in first out method, which states that under the FIFO method the earliest goods purchased are the first ones removed from the inventory account. This results in the remaining items in inventory being accounted for at most recently incurred cost, so that inventory assets recorded on the balance sheet contains cost quite close to the most recent cost that could be obtained in the marketplace. This is a question of FIFO method. You can read it, and this is the solution of it. Here you can see the things which have the inventory which is come first is taken out first. Now the LIFO method, it states that last in first out. It is used to place an accounting value on inventory. The LIFO method operates under the assumption that the last item of the inventory purchased is the first one to sold. Now in the illustration you can very well see that the inventory which is purchased late is first taken out for use. The next is the weighted average cost. The weighted average method is used to assign the average cost of production to a product. Weighted average cost is commonly used in situation where inventory items are that is impossible to assign to a specific cost to an individual unit. This is the formula of weighted average cost per unit, that is cost of goods available for sale divided by units available for sale. This is the question. You can very well read this and understand this. Now this is a comparative study under LIFO, FIFO and value added method. I hope you are now aware of all the three methods. Thank you for being such a cooperative audience. Thank you.